Welcome back. Welcome back. This is the Intelligent Developers featuring Andre Bueno and Gerard Delane. And today we have an extraordinary guest, Mr. Jim Simmons. Jim, how are you?
I'm well. How are you?
I'm well. I'm well. Andre, how have you been, man?
Been very, very excited about this conversation. One of the things that I'm just so fascinated about Jim's background is that you've worked on the public side, you've worked on the private side, you're now running your own shop. And I guess just kind of jumping into it, how did you first break into the real estate industry?
It was somewhat, I don't want to use the word happenstance because I think that things happen for a reason, but the transition was not something that I would have predicted given my early career path. I was an engineering major out of college and I practiced engineering for the first 4 years, working at General Electric in one of its management training programs. I got the opportunity to transition to Wall Street and to essentially move back home to New York. After doing that for a couple of years, I went to get an MBA and then went back to Wall Street. And during that period of time, I was asked to take a leave of absence to go help to really jumpstart an economic development agency, which was charged with revitalizing Upper Manhattan. And so through that exercise, where I ended my tenure there as CEO for a couple of years, much of what we did was real estate oriented, because what I realized was you can't really change the nature of a neighborhood unless you can either control or effectuate change via real estate. And so I focused much of our energy and time on real estate related activities during my tenure at the Upper Manhattan Empowerment Zone. That was my initiation. And then I translated that into roles at Apollo and Ares Management, which is a better part of 17 years of my career.
That's incredibly impressive. I mean, as you talk about the impact CDFIs have in communities of color, I guess, could you expand more on, I guess, more concrete examples of the type of work that you were doing and the type of impact you were able to have?
Yeah, we utilize city, state, and federal funds and operated them in a fund-like manner to really persuade developers, owners, operators, and investors to invest their capital in Upper Manhattan. And our money could be defined as fulcrum capital, that which without it, the deal wouldn't have gotten done. And so we also were the marketing agency for Upper Manhattan. We were cheerleaders, we structured transactions, we were intermediaries between city, state, and federal agencies, really to pave the way for development to occur.
And I think no funding structure is perfect. But I think you have had a great long career doing fund management. For our listeners, can you talk about some of the benefits to a sponsor for having a fund structure as a way of doing real estate deals?
You mean outside of the structure that we had at the empowerment zone?
Either at the empowerment zone or on the private side.
Well, the reason, so let's sort of divide that into two conversations. The reason why I structured it as in a similar to a fund was to be able to recycle capital, right? So to make investments as opposed to grants where there's an expectation for returns. And those returns could therefore be reinvested in new projects. So that was the impetus behind the structure there. I think from a private perspective, funds are useful because they are amalgamations of capital that come from various sources that are directed towards a specific project or a specific geographic region. I don't think that funds themselves, in and of themselves, give any real benefit to making an investment or not, other than the fact that it's A, in theory, ready capital, and B, in theory, depending on its structure, the manager of the fund has discretion to deploy that capital as they see fit. So it provides a level of flexibility that either a separate account or one-off deals don't, where you have captive capital and you can deploy it and you can deploy it quickly, and your infrastructure to be able to make decisions is much quicker and much more efficient. But so long as you have capital that is ready, willing, and able to invest, I'm fairly agnostic. And I think that the process, and I think I know because I've been through this, the process of raising funds is time consuming and expensive. And I think that the energy in doing so can be equally deployed in actually changing the neighborhood or making the investment, as opposed to the exercise of raising capital. So there are a finite number of hours to the day, minutes to the hour, seconds to the minute. So the more time that is spent in the exercise of raising capital, which is really time consuming, can be spent in deploying capital and finding really great deals. And so there's always a balance. And I just always ask people to think about, how much time do I want to dedicate to the exercise of raising money versus the exercise of actually deploying capital?
And I've spent most of my career on the entrepreneurial developer side. And for most developers, it's kind of like every single deal you're kind of starting all over, right? You find the deal, find the opportunity, get it under contract, raise the money, go meet investors. Investors want to review the deal, they want to review you as a sponsor, and you kind of like start and stop every time. Part of the attraction, as you mentioned, is that you'll have ready available capital. But I've heard the comment that you said, which is it takes a very long time and a lot of effort to do that process versus just doing it on one-off deals one at a time.
Yes, you have to believe the adage that a good deal will always find capital.
That's what I hear.
So if you believe that, then if you believe that your deal is good, which I presume you would, or else you wouldn't be doing it,
Right.
then it's just the question of, can I find the right capital, the best capital to do that deal? And raising capital for a deal is based upon the same types of relationships raising fund capital is. I just think that the process to get to a yes for a one-off deal is a lot more efficient than the process to get to a yes in raising a fund.
Love it. Excellent advice.
The real difference is the speed to a no, right? I really would rather know that it is a no sooner than later. And with the fund, within the confines of the fund structure of business, there are a lot of long maybes. And those long maybes, or contingent maybes, or contingent yeses, those are the ones that take up a lot of time, money, and energy, because you still have to do run the same traps as you do to get to a yes. So So
Right.
all the diligence that they're going to do on you, all the diligence they're going to do on your infrastructure, your track record,
Right.
they're going to do that to get to a yes or a no, irrespective. Whereas if it's a deal, they're only going to do that if they really like the deal. Right? They're only going to run you through those paces if they say, okay, we like the deal. Now let's do our diligence on the person, on the back office, on the infrastructure, the team.
With the changes in the macroeconomic landscape as it relates to lending and the various challenges with regards to liquidity that we've been seeing in the markets, have you seen that impact the way that you, I guess, been growing your company?
I would not say that it's changed. So let me try to parse the question, right? There are two parts to capital markets, right? There's the debt, and then there's the equity market. The debt market has changed in a sense that everything that we read in paper, interest rates have risen. We've had the banking crisis. We have lenders that are pulling back because of the recent rise in rates, because uncertainty with inflation and the like. So it is harder to find debt to do deals, and I will say marginally harder. You can find it, it's just going to be more expensive, right? And there are lenders that are out there that are putting money to work. You have, if you're in a space where we are, where you have the GSEs, they, or the government sponsored entities, they continue to put money out. So there's not, we don't find that there is a lack of debt capital to execute our transactions. On the equity side, when you get to a point of uncertainty where we are today, where people really can't predict where the market's going to go, and there are a number of factors. You have global macroeconomic uncertainty. You have a war in Ukraine. We have a debt ceiling that the outcome is uncertain. We have a banking crisis that we've just gone through. We've had the quickest rise in interest rates probably in the country's history. We've also had a spike in inflation. All of this confluence of events means that investors really have a hard time predicting what the next 3 months, 6 months, 12 months is going to look like. So what that means, more often than not, is that they say, hey, we're going to take a break, and we're going to take a pause, take a breath, and see where things shake out before we continue to put out money, even though they may have mandates to do so. So what that means from a fundraiser perspective is, to the extent you're having conversations, those conversations go on pause. And to the extent you had a fundraising calendar in your mind where you wanted to meet certain bogeys, say I wanted to be at $200 million by date certain, and another 400 by date certain, and another 600 if you have a $600 million raise, those dates get pushed back. And as we all know, within business framework, time means money. And the longer dates slip, the less money you can put out to the extent that you wanted to in this time of uncertainty. So from an equity perspective, the broad-based uncertainty means that investors are less likely to make commitments today than they were probably 6 months ago, 12 months ago. And hopefully we'll get back to some norm so that 3 months from now, 6 months from now, 12 months from now, they will be more willing to put capital out. But if I were a soothsayer, I'd be retired.
Love it, love it, love it. Let's go back a step. So you made the transition from the Upper Manhattan Empowerment Zone to Apollo. Can you talk a little bit about your experience working, on the corporate level, investing in communities?
I was extremely lucky, and I was extremely lucky because I was late in my career to transition to A, real estate, B, private equity, and C, to a place like an Apollo, which is a brand name. I had people who were there who believed in a couple of concepts that I think were critical to their accepting me and my ability to implement the business plan that I had in mind and to build the team that I did. Apollo had, and I don't say had because it's past tense, I think it continues to have, but the mantra then was, hey, if you have a business mode in mind, and it's particular to, not specific to, particular to Apollo Real Estate Advisors. I think it's true for Apollo at large, but my interactivity was limited to the larger Apollo global framework relative to Apollo Real Estate Advisors. But it was, hey, you have an interesting business model. We believe you're smart. We believe that there is the ability to invest capital, to attract capital to a sector of the market that previously was not deemed to be institutional. And that was multifamily in these reemerging submarkets of large metros. So you think Boston, New York, DC, San Francisco, Chicago, they all had neighborhoods that during the 60s or 70s were depopulated, and that through the 90s and early 2000s were being repopulated, to boil down the strategy to a simplest form. And that the repopulation was either organic or driven by external forces like governments or institutions like universities, hospitals, and the like, but that we could not only take advantage of the repopulation, but be a part of the revitalization of those neighborhoods. And so that basic business model was put forth, and it was believed in by the partners. And so we ended up starting to invest on the firm's account, and then we ended up raising a separate account and then raising a fund. And that's sort of a natural progression, right? You test it with your own money, then you get some specific money, then you go and get general money. And so I think it was the belief in me, quite frankly, which, you know, I say that I've had several angels, godfathers, godmothers, rabbis, and priests in my life that have helped to lead me on a proper path. So it's people like that who said, hey, we believe in you. Let's go do this together.
Incredible, incredible. So you went to Apollo, and then from there, did you start Ashland Capital?
No. So Apollo, as Apollo Real Estate Advisors, the fund management business went through a couple of different corporate iterations. In general, the group of people who were investing in the team stayed largely intact over the 17 years between the start at Apollo Real Estate Advisors and the end at Ares Management. And I had a great career, but I ended up deciding to lift my team out and start Aslan for a couple of specific reasons. Number one, when I started at Apollo Real Estate Advisors, it was a small shop, very entrepreneurial, a handful of people. We were able to make decisions as a small group fairly rapidly, and could invest in ideas that we felt could make, you know, our investors a, you know, prescribed return. Fast forward to the end, Ares Management was a very large, publicly traded, alternative, world-class alternative asset manager. And so the entrepreneurial flavor was different. It changed. I mean, as corporations change, you have to change, right? You have to formalize procedures as well, they should. Being an entrepreneur was very attractive. B, I had built a team that was very successful. I felt deserved the ability to go out and raise capital, continue to do what we were doing. Not to say that that wouldn't have happened at Ares, but Ares was looking at really large ideas, as opposed to my last fund was about $500 million. But Ares had graduated such that it was looking at very, very large vehicles as opposed to smaller vehicles. And then lastly, it had to do with me looking myself in the mirror and say, okay, you're at a certain stage in your career where, A, if you don't do it now, you will likely not do it. B, there's no difference, in my mind anyhow, between yourself and these are people who I look up to, but a Tony Ressler, a Mike Garanghetti, Bill and Richard Mack, in saying that, or Barry Sternlicht, that you can build an enterprise. And why not? Why can't I start Aslan and then 15 or 20 years hence, it not be one of those? Because Ares's lifespan is inside of 20 years, I think. Apollo, all of these, let's just put it this way, all of these all of these companies have been built since I've been an adult. That includes Carlyle, that includes Oaktree, Apollo. So, in the balance of my professional career, if I so desire, I should be able to, with the experience, with the pedigree, build something of that order of magnitude, again, if it's in the cards. So I've been asked before if I had fear or trepidation in making that leap. And obviously you do, because you don't know what lies before you to some regard. But I had a large amount of fear and trepidation if I stayed. And I said to myself, what are you going to do 10 years from now? You look yourself in the mirror and you say, well, you didn't even try to build something that's quote unquote in your likeness, or at least as you think a firm should be built. And so when I came to that realization, I said, listen, if you don't try, you're gonna have to look yourself in the mirror. And the fear of looking oneself in the mirror and saying the only thing that kept you from leaping was fear, I said, I have to do this.
And when you made that jump, I mean, you pretty much hit the ground running. Like what year was that, to be specific?
2019.
2019. So, and
Jan 1.
And then your project at Harvard was pretty much announced shortly thereafter. Is that correct?
No, that came a significant period of time after that. Our first set of transactions were two. One that was multifamily asset here in New York City, and the other was a multifamily asset in Old Town Alexandria. And we acquired them in November of 19. Both were preservation deals for affordable housing. Both had entitlement pieces to them where we were increasing the amount of housing on the site and the campus. Both had public-private partnership aspects to them, where we partnered with the city of Alexandria and partnered with the city of New York to not only retain affordable units, but to expand the number of affordable units. So very similar transactions, but they were our very first partnership / separate account was with Stepstone Group. And I will always be grateful to them, because they were the first to say, hey, we believe in you, we believe in the team, and we'll invest with you on your first transaction off of the Ares / Apollo platform, which even though the track record was mine, and again, this was not something that Aries quote unquote had to do, was to allow me to take the track record, which again, I'm grateful to them for doing. You still have on the part of LPs, the question of, well, is it really your track record or was it because of the platform? And how much was you and how much was the platform? And so, you know, you still have to make that connection and say, hey, it was really you that was making the investment decision. It was you that was making the disposition decision. It was you and your team that executed the business plan from cradle to grave, as we like to say. And so once the Stepstone team got that and had an amount of belief, they, you know, supported me from then until today, quite frankly. There has to be, and these are, even though these are institutions, there has to be a person who says, you know what, I believe in this person, and there are going to be peaks and valleys, and I'm going to carry the flag for that person, that firm, through those peaks and valleys, such that, you know, I'm going to back them, because there were countless times where that flag could have been dropped, and I would have understood why, because there are peaks and valleys, and, you know, sometimes the flag gets heavy.
You know, what's neat about that Harvard project specifically is the partnerships. I think in real estate in general, you know, doing joint ventures, doing partnerships is pretty common. Can you speak a little bit about that project?
Sure. So that's a project, and just to summarize, it is a project that is on Harvard's campus. Its expanded campus in Allston, Massachusetts, which is just across the river from Cambridge proper. Harvard issued an RFP for the development of a life sciences campus. Tishman Speyer responded to the RFP. I happen to have a long-standing relationship with Rob Speyer. Rob, based upon that relationship, approached me and asked if I'd like to partake as a partner in the project. It started as an innocuous conversation. Matter of fact, he said, "You're a multi guy. This is life science." This was just in the course of regular conversation. He goes, "I don't know if you'll be interested, but I'll show it to you." He ended up showing it to me. I thought it was compelling. What started with just really me being interested personally, and it grew to my firm being interested, as well as us quote unquote syndicating a not insignificant amount of capital, specifically from people of color, to invest alongside my firm and Tishman Speyer. I think that was the groundbreaking part of sort of what we accomplished, which was the demand for that type of product, which is high quality institutional investment product that people within our community don't get access to, and to have a world-class team, not only of operators, but also investors that are co-investing alongside. That was the newsworthy part of the transaction. But it has led to a deeper relationship with Tishman Speyer, that we're going to do a number of things in the future. And, you know, I'm pleased with the partnership and friendship with Rob on many levels, as well as his team.
Absolutely amazing. You know, the ongoing quote is, you know, relationships are everything. And in real estate, you know, this is a relationship business. So I think this is a great example of that.
1,000%.
Absolutely.
And, you know,
Absolutely.
I'll give Reese to commercial, I mean, that's exactly what we try to foster within Reese, which is the sort of the fertile fields for relationships to germinate and grow. Right. So there's nothing forced about anything within Reese to say you should work with party A, B, C, or D, but we try to provide the spaces and the infrastructure for people to find each other organically. And if you look at some of the things that people are doing together now versus call it 5 or 10 years ago, I think that we've succeeded to an extent with that. But relationships are everything. I figured that out relatively late in my career. I had peers of mine who knew that walking into college freshman year, that relationships are everything, and part of why you're here is to establish them. I didn't figure that out until I was basically walking out the gates. But you learn as you go, and hopefully my children will know walking in as I didn't. So
I love it. I love it. So, I guess my last question would be, if you could talk to walking out of undergrad Jim Simmons, what advice would you give that young man?
it's the same advice that I give many sort of young people that I speak to today. I mean, I'm a big believer in the fact that there's no way I'd be where I am without the hands of many reaching back and helping me get to where I got to. So I try to do that as much as possible. And too often we are focused on the career itself, or the building of the career, or the job. And we place so much weight on where should I start my career? What job should I accept coming out of school? And that is much, much less important than sort of one critical piece, which is if you are the very best at what it is you are doing, you will get noticed. You'll get noticed. And that notice will create and present opportunities for you. It's not by osmosis that people get opportunities. They get tapped on the shoulder to say, hey, we think that you'd be great for this or for that. Or if someone calls them and says, hey, I'm looking for a smart person who's diligent, who's hardworking for this or that. That happens all the time. And you want to be the person who gets that tap or gets that call. And so I tell people all the time, I've had 4 careers, and we just reviewed them. All right, I was an engineer, then I was on the street, then I worked at an economic development agency, and then I went to private equity. So it's 4 separate and distinct chapters to my professional career. If you'd asked me when I started at General Electric in 1988, whether I'd be where I am today, I wouldn't even be able to imagine it. So, again, this is in theory because I can't tell you that this is fact because I wasn't one of the ones who was judging me at the time, but my going through the Edison engineering program, my going through Solomon Smith Barney's training program, my going through my being affiliated with Twigo and French American Foundation and some other organizations where there is a level of excellence, A, to get in the door, but B, that's expected of you, and C, that if you're driven, that you perform to, then you will get noticed. And I'll just give you one anecdote. Again, as I said, I didn't figure out a lot of things until later in my career, but after I graduated from business school, I landed a job at Solomon Smith Barney, and we were in a training program. And I said to myself, one of the tests, and this was old school, but one of the tests was that, interns or people who are rotating through desks, you should be there first. And first means first, right? And I landed on emerging markets derivatives desk, which had, varying times when markets open around the world. So I routinely was in the office between, call it 5 and 5:15 every day. And I made it my charge to be in first that entire training program, just to prove that I was going to be the hungriest in the class and that I wanted it more than anyone else. And it didn't matter what we did the day before. It didn't matter and you were expected to be a full member of the team, and that meant socializing, that meant going out with clients, that you had summer events, whatever the case may be. And didn't matter what time you got home, I had to be in at 5. And so that's a small example of, again, something I learned later in life that people took notice of. And I know that because they told me since. That helped me land on the desk that I wanted to land on, which was emerging market derivatives, which was at the time the most profitable desk within, the fixed income sales and trading universe. So if you are great at whatever it is you do, you will get noticed, as I've noticed people who have been in our mailrooms, who I've plucked out to be, to have a higher and better use than being in the mail.
Absolutely amazing. We're going to end it there. Jim, thank you, man. We truly appreciate you coming and speaking with us today.
Thank you for having me. It's always good to see you gentlemen, and I look forward to having someone listen to this, hopefully.
Absolutely. Absolutely. All right, Jim. Take care.
All right. Thank you.
Thank you, Jim. Bye-bye.